Welcome back to Financial Clarity for Doctors, everyone. This is Rachelle Vanderzanden here with Corey.
Hello.
We are going to talk today about what to do with the extra money you have lying around if you have extra money lying around. So we do have, I feel like at least I have a lot of clients right now that are kind of sitting on cash, and it might be like they want to buy a house or something like that, and they feel like it's not a good time. So they're waiting. They're saving up money for a larger down payment, and they just know that they're probably going to have this money sitting around for a year or 2 years. And realistically, like if we're in a pretty stable financial situation, everyone's sitting on at least a little bit of money. Like you've got that cushion for emergencies and things like that. So that makes sense. We want to make sure that we have a cushion. We want to make sure we're saving proactively for our short-term goals and things like that. It can sometimes be unproductive to sit on too much money, but if there is a good reason to hold on to that, it's kind of like, what should we do with it? Like people don't want to just let it sit in their checking account. Like they want to be feeling like they're doing something that's better with that money. So today we're going to spend a little bit of time chatting about, good reasons to be holding on to cash. Maybe less good reasons to be holding on to cash and maybe considering doing something else with that cash. But also then, assuming it is a good thing to be doing, where should you be putting it? What's a good vehicle to use for those short-term savings dollars? Take it away, Corey.
There we go. So good reasons to hold on to money. Um, Obviously emergencies. I think the default recommendations you'll see out there are 3 to 6 months of your expenses set aside for emergencies. But go with whatever you're comfortable with, whatever makes you sleep well at night. If you need 6 months, if you need 9 months, if you're good with 4 months, it doesn't really matter. Just go with probably minimum three. uh, Maybe maximum 12 months unless we got some unique circumstance. But yeah, emergency reserves, everyone should have some cash for that. And then like Rachelle mentioned, if we're planning for a major expense in the next handful of years, so I would say less than 5 years, if you know you're going to need that money, whether it's for a home down payment, a major home repairs, a big vacation, maybe you're taking a sabbatical, we got to send our kids to college. You want to buy Rachelle and I a nice birthday present, whatever it is. If it's, in the next few years, we probably shouldn't invest that money in your traditional investments because investments can go down in value and sometimes take a handful of years to recover. So you potentially, if you invested money now, 3 years from now, it might be less than what you started with today when you invested it. So, try and stay away from the stock market, even bonds probably. We'll talk, there's certain types that might make sense, but anything that can go down in value or tough to get your money out of, real estate, just stay away from that if you need the money in the next handful of years. And maybe again, endless reasons why one might want cash. Maybe your income is variable, so you like to have some extra cash on hand, even though you don't really need it in the short term, but just in case. So, but whatever the case may be, if you have a valid reason for it, we can totally support that. Now, what are some reasons why you probably shouldn't just hold on to cash, Rachelle?
Yeah, I know. It's so hard to talk about this because really it's like never bad to have money in the bank. Like that's a good thing. That means you're spending less than you're making, all of that kind of stuff. But I do think that it's not always the most productive thing to do with your money. So if you're not saving for a short-term expense, if you have plenty for emergencies and then some, and really you just have extra money laying around, like we don't want to be hanging on to that just because we're kind of afraid of doing anything else. Like, hopefully, that's not the reason that you're doing that. If we think about being fearful of investing, it can make sense. Like, investing is volatile, but there are other risks long term that you shouldn't ignore either. So, like, if we're not investing and you're just holding on to money in a bank account or something like that, like, then you're working against inflation, and inflation is a big risk for your long term money. So ideally, we can do something more productive with any money that really is truly extra so that, we're working towards long-term goals too. I think another reason that people sometimes hold on to money is they have this like aversion or like this fear that they're going to run out of money at some point. And sometimes it has to do with like something that's happened in the past, maybe not having a ton of money during training or not having a ton of money as a kid. But dependent on your salary, like you may be in a much more comfortable position now. And sometimes it just takes people a while to get used to that. And so they end up building up cash and cash and cash and cash for no particular reason, but just because it makes them feel more comfortable to have a bunch of cash. And like Corey said, like we want you to have adequate emergency reserves, whatever that means to you. But don't let it just to continue to build beyond that. Like find a number. When you have that amount, anything above that is extra if you're not saving for something specific. I think the other people that money or like people often hold on to money is just because they don't know what else to do with it. They just, it's just kind of a default. Like I'm making significantly more than I was before. I'm not used to making this much money. So I'm not used to making decisions about what to do with my money. You know, I just had enough to pay the bills before and now I have all this extra and I don't know what to do. So that's another not great reason. And like eventually you got to figure it out, like figure out something to do with your money. But there are lots of situations where it makes sense to hold on to cash. So I think the majority of the time today we're going to spend talking about like what do you do with it? And maybe it's not cash, but we're using cash as like a shorthand for anything that you need for short-term money at this point. So lots of places you can potentially put those savings dollars, your emergency reserves, and your like short-term savings money. The easiest one, Corey?
Yeah. So, obviously if you have extra money, we could invest it or pay down debt or spend it, but we're assuming you don't want to do any of those things. So for short-term money, probably the most straightforward one that we recommend to everybody, where there's very few things that we recommend to everybody, but this is one of them, and that's a high interest savings account. So, most of the major brick and mortar banks out there don't give you much in the form of interest. Still use your normal bank for, your regular bills and purchases. You have ATMs on every street corner in most major cities, but beyond just your day-to-day purchases, keep the bulk of your savings in a high interest savings account. And high interest is a relative term, but right now you're looking at about 3 to 4%, which is about 3 to 4% more than a typical bank checking account will pay you. Most of the common ones are online banks. They don't really have a brick and mortar location. Some have a few branches around the country, but most of them is just strictly online. Feel free to just Google high interest savings. You'll find plenty of options out there. Run them by us if you have questions. But basically, what you want to look for is make sure it's FDIC insured. So any legitimate bank will be FDIC insured, which means the government will insure your balance up to $250,000 per account registration. So you could own an account in your name, your partner could own one in their name, you could have a joint account as well. That's 3 separate registrations there. Obviously, if you have 250 at multiple banks, each separate bank has their own FDIC insurance. So, very safe. Obviously, if the bank goes out of business, that's not good, but it's FDIC insured, so the government's going to insure you up to 250,000. So, pretty low risk there. You get, your same interest rate on all your balances. Now, that 3 to 4% I mentioned, this is as of late February. That could change by the time you hear this. It's variable. It's going to fluctuate up and down with the overall interest rate environment in our economy. But ideally, we get that same interest rate regardless of the balance. Whether you have $1 or $1,000,000, they're going to give you that same interest rate. There's some banks out there where they'll give you a higher interest rate on, say, the first 25,000, but then after that it drops off. So ideally, we're getting that attractive interest rate on all the money that we put in there. And then preferably there's no fees, no minimum balances, no transaction costs. So like you can move money to your regular checking account as needed without any hurdles or costs associated with that. Most of them have phone apps. Like the bank I use, I have an app on my phone. I can transfer money back and forth to my regular checking account with a couple clicks of my finger. Piece of cake and very convenient. I think most of these savings accounts, they'll limit your transfers to 6 per month, but I mean, who needs to move money from their savings to checking 6 times or more per month? It's, maybe you're transferring it once or twice a month at most. So yeah, shouldn't be an issue there. And that's just a fantastic spot for your emergency fund and any other short-term savings where you might need that money soon, and you can get a little bit of interest on it to try and keep pace with inflation with those dollars.
Absolutely. It's really liquid. I think I mean, those are the two best things about it. It's really liquid. You can earn some interest, period. It's great. If you do have money in one of those savings accounts and then in your checking account, just keep in mind that it's going to take a couple of days to process transfers. So always make sure you have enough in your checking account for sure. I think another related kind of banking product is like certificates of deposits or CDs. We have clients ask about these quite a bit too. Um, I mean, they can be really attracted for when you have a savings goal in a specific time frame. So let's say I would like to buy a house. I know it's not going to happen in the next year. I do think it's going to happen between like 1 and 2 years from now. So it could be attractive to do like a 12-month CD. The benefit is that you get a higher yield. So one bank I was looking at before this call has a 3.75% yield on the savings rate and then a 4.5% yield on a 12-month CD. So you get a little bit more interest. I think that what you're getting for that, like that little bit of additional interest, is maybe not worth giving up the liquidity, but it really does depend on your goals. Maybe for you, it is worthwhile. Maybe you know you're not going to need that money for the next year or so. Not appropriate for your emergency reserves because, like, if you end up taking money out of it, you lose all the interest you earned, and it was like not even worthwhile to have it in there in the first place. And I think the other thing is that when you buy a certificate of deposit, generally the yield is fixed, whereas the yield on the savings accounts is variable. So if interest rates went up, like it's possible that you could have a higher yield on the savings account than your fixed rate CD at that point. And I don't know that that will necessarily happen, but just keep in mind that they're two very different products and can be used for different uses. I like liquidity personally. I think that if we're going to buy a CD, like obviously, hopefully you're getting a good chunk more yield for that to be worthwhile. Like I don't know if there's like a line in the sand for you, Corey, but I think I would want quite a bit more in order to just commit to that.
Yeah, I think some of it just depends on your prediction of the future, which we know is very hard to do. But if you're of the mindset that you think interest rates are going to flatten or potentially even come down over the next year, locking in that 12-month CD at 4.75%, which or 4.5%, which is 0.75% higher than the bank savings is giving you. If you think that that bank savings is at its peak or might even come down, yeah, that CD is pretty appealing. But if you're of the belief that the Fed's going to keep raising interest rates and interest rates in the economy are going to keep rising, inflation's going to be persistent, well, maybe going with that variable rate bank savings account that will, there's going to be a little bit of a lag, but if interest rates in the economy keep going up, the bank savings will ultimately follow. So you might want to stick with the savings account in that scenario. No right or wrong. It's a guess, and flip a coin, see what you see what the answer is going to be. Um, we don't have a crystal ball, so we can't tell you. But
Mhm.
yeah, I think that's probably the deciding factor. If you think, what direction do you think interest rates are going? And
Yep.
if you know, tell us.
It's kind of interesting because you can tell what the banks think by looking at the yields on their CDs. So when I was looking today, the yield on the 12-month was higher than the savings account. The 18-month was a little bit higher than that, but then the 24-month CD was actually a lower yield than the savings account even. So it's obvious that the bank thinks, okay, interest rates aren't going to stay this high forever. They're going to come back down eventually. So we don't want to lock this yield in for 2 years and then have to pay that out if interest rates are lower at that point. But the bank doesn't really know either. It's anyone's best guess at this point.
Yeah, it's just some people working at the bank that are taking a guess. They know,
Absolutely.
maybe they know a little bit more than you or I, but I mean, they could be wrong.
Yep.
Um, let's see, another one, I bonds. We've mentioned these before. Government Series I savings bonds. They've gained a lot of popularity over the last couple years as inflation has jumped and therefore interest rates have jumped. And I bonds have been around for a long time, but no one really paid them much attention in the last 15 years because they weren't that high interest. Right now, I believe they're paying just under 7%. Every 6 months, that interest rate will adjust, and they do it once in the spring, once in the fall. But whenever you buy the bond, you're locked in for that 6 month period, and then 6 months after, you'll go to the current rate, and then again 6 months after. So it'll go up and down. But they're designed by the government to provide a net positive return for investors after inflation. So really, no matter what, after you factor inflation in, you should be seeing growth on your money as a result. So they're pretty attractive. You can't really get I mean, it's all but guaranteed. It's the US government. They can print money to pay you back if they need to. So, I mean, I guess if they default on their debt, you won't get your money back, but that's a pretty darn low risk. Um, so, they as a result, they limit how much you can buy. Currently, you can buy a maximum of $10,000 worth per person per year. But yeah, pretty attractive spot for your extra cash, getting a almost guaranteed 7% interest rate on your money. Hard to beat anywhere else. So pretty appealing. Now there are a few catches. You have to hold on to these for a minimum of 12 months. You can't liquidate them before that point is up. So it has to be money you don't need in the next year. And then if you were to liquidate them within 5 years of purchasing, you give up the final 3 months of interest that you earned. Still a pretty good deal, in my opinion. Or your 7% rate turns into about a 5% rate or 5.5. If you liquidate it before the 5 year mark, still better than any other fixed interest product out there. So that's something I'd be willing to to deal with if I needed the money before the 5 year mark. Um, but yeah, no, that's a nice supplement to your short-term savings with money that you don't necessarily want to invest or part ways with, but you don't need in the next 12 months. You can get a little bit more interest on your cash with I bonds.
Hmm. I think the relative benefit of those has gone down just because like savings rates or savings account rates have increased and the yield on the I bonds has decreased. And I think there's going to get a point where it just doesn't make sense anymore necessarily. Right now, I think it's still attractive, but it all depends on if you're willing to give up that liquidity. Because even with a CD, you can sell out of the CD if you want to, even if you haven't satisfied the full term and there's just some penalties. With I bonds, like it's not like that. You can't have that money back until 12 months. Like it's gone. It's like practically not your money anymore for a certain amount of time. Um, but yeah, I think, if it's worth it to you to get a little extra yield on $10,000, go for it. I think for some people, it's also just like, that's a lot of hassle for a couple of extra percentage points on $10,000 over 1 year. And so, yeah, I think it all depends on the person too. Like some people are willing to jump through all the hoops to get that, and other people not so much.
Yeah, you got to buy them directly from the U.S. Treasury, so you'd have to create an account with the Treasury website, which isn't hard, but it's another account that you have to
Hmm.
have and remember a password for. And I've heard some horror stories of people who've forgotten their passwords and get locked out because it's the government and it's hard to get it reset. I think you have to like call and talk to someone. Um,
Oh
but
no.
but I mean, it's still no matter what, they're probably always going to offer a higher interest rate than your high interest savings accounts. That spread, like Rachelle was saying, may not be quite as great as it was a year ago, when you were getting almost 9% or something on your I bonds and 1% on your savings accounts. Now that spread is less. But even when interest rates were zero and your high interest savings were paying 1%, I bonds are paying 3.5%. So it's still going to be better than your typical bank savings. But yeah, is it worth it to you? That's, personal decision.
Absolutely. Another kind of like US government investment is like short-term treasury bills or T-bills. So they vary in duration. So you can pick one that's only 4 weeks. You can pick one that's 2 years, and the yield will be different depending on what you pick. Very similar to like the CDs. Like your 12-month CD has a different yield than your 18-month CD or your 24-month CD. The 6-month T-bill right now is currently yielding just over 5%, which is great. That's a great yield. Just as an example, like when you purchase bonds like this, you buy like they're $1,000. At the end of the term, you get your $1,000 back plus the interest that you were um, promised, I guess. And this is the very similar thing to the I bonds also, where it's not guaranteed, but it is backed by the full faith and credit of the US government, which means unless the US government starts defaulting on their debt, you will get your money back. And I know, Corey, you're talking a little bit about like that's fine. It's like not going to happen. There's been a lot of like bad news and press about is the US government going to default on their debt and things like that. And I think it's important to know that like drama in Congress does not automatically mean that you don't get your bond money back. So I think that there would have to be a lot of things that went wrong beyond drama in Congress and not being able to pass a budget and raise the debt ceiling and things like that before something like that happened. So still very safe products, relatively speaking.
Yeah, I mean, this isn't the first time, it won't be the last time that we're up against the debt ceiling and Congress
Hmm.
is making a big deal out of it and both sides are fighting and demanding for ridiculous things. But I mean, the whole country is going to be picketing outside of Congress if they don't come to some agreement at the 12th hour or whatever, the final hour on the last day that they have. So
Hmm.
I'm confident they'll get something figured out and the US government won't default on its debt. Or if they do default, it'll only be for a week and you will get your money back. But that's
Hmm.
just my opinion. I don't have a crystal ball.
Politics.
Yeah, not my favorite. Anyways, so another option, and I don't even know if we should be bringing this up, but it's worth mentioning because it is a viable option that could be appealing to some people out there. Definitely a little more complicated than the stuff that we just ran through, but the world of structured investments, and specifically in this particular scenario for money that we think we might need in the next handful of years, market-linked CDs and issuer-protected or buffered notes. Now to translate that to English, what does that mean? So we already talked about CDs. CDs are a bank product, so they're FDIC insured. So you'll get your initial investment back, even if the bank, goes out of business. And the nice thing about these structured investments is they can be appealing to someone who sort of wants to invest in the stock market, but doesn't want to see their investment go down in value, which is really all of us. We want to invest and see it go up, but we don't want to see it go down. Unfortunately, in order to benefit from the long-term growth potential that the stock market has historically delivered, you have to be willing to endure some choppy years from time to time. But for those of you who aren't willing to endure the choppy years, you can still have like 1 foot in the stock market and 1 foot on dry land. If you're willing to sacrifice some upside potential in favor of downside protection. So these structured investments, there's a zillion different types, a zillion different flavors. This is just a small segment of them that we'll talk about today. But for example, you can link them to an underlying stock market index like the S&P 500, for example, but it has a floor and a ceiling. So you potentially could have higher returns than your typical bank savings account or even government bond or CD, but you also just might not get any growth out of it if the underlying market index goes down. So let's walk through some scenarios and examples. We'll start with a market-linked CD. And again, CD, FDIC insured up to 250,000. So you're all but guaranteed to get your money back, even if the bank goes out of business. The government's going to insure you up to $250,000. Just your principal amount invested. So not the interest, but the principal you invest. So let's say, for example, you buy a 2-year FDIC insured CD with an S&P 500 index as the underlier that it's attached to, and it has a 12% ceiling. So at the end of 2 years, if the S&P 500 is higher than where it is today when you buy the CD, you get credited with the growth of the S&P 500 up to that 12% cap. If the S&P 500 goes down and is lower 2 years from now than when you bought the CD, you would just get your initial investment back. So, Rachelle, you mentioned that Earlier the 1 year CD you were looking at was 4.5%. So if you extrapolate that over 2 years, 9%. So this gives you potential for more upside, 12% versus 9, but there's also a chance you just get your money back with no growth. So, risk return, is that worth it to you? I don't know. It may or may not be, but it's a way to, again, sort of participate in the market while still protecting your principal. Now, structured notes, different than CDs. CD, bank product, FDIC insured. A note is a debt product, it's a bond basically. So it's only, it's subject to the credit risk of the issuing institution. If it's issued by a bank, it's subject to that bank's ability to repay their debt. So you'd really only want to buy them from a strong, stable financial institution, a large bank, basically that's heavy with cash. And most big banks now are in pretty good financial shape. But just, again, that's the risk. If the bank defaults on their debt, you may not get your money back. And that's any bond, from any issuer. If they default on their debt, you may not get your full amount back. You might only get a portion. You might get zero. So again, example, if we just kind of stick to similar numbers, we did a 2-year CD, let's do a 2-year note, link to the S&P 500, floor of 0. So it's issuer protected. Again, as long as the bank's in business, you'll get your money back, even if the S&P 500 goes down. But maybe instead of a 12% ceiling, the note has a 15% ceiling. Not FDIC insured, it's just bank protected, so you get a little bit more upside over that 2-year span. So again, could be appealing. You potentially could have more growth potential than your typical savings account or typical CD or typical government bond. But there's a risk you just get the principal back or potentially less if the bank defaults. And I mean, these things can be designed in a number of ways. Maybe you're willing to take on a little bit more risk in favor of a little bit more upside. So instead of having a hard 0% floor, maybe instead you get a note with a 30% downside buffer, and therefore it has an upside cap of maybe 25% on that 2-year note linked to the S&P 500. So in this example, the maximum you could lose is 70%, if the S&P 500 goes to 0 because of that 30% buffer. Now, if the S&P 500 goes to 0, we got some bigger problems at hand, but that's a different subject. So if the S&P, in this example, if the S&P 500 30% buffer goes down by less than 30% over the next 2 years, maybe it's down 20%, you would just get your principal back. You have that 30% buffer, so you would get, the initial investment back, no losses. Pretty cool. Now, if the S&P 500 is down more than 30% 2 years from now, say it's down 40%, with that 30% buffer, you would only have a 10% loss on your investment. So you would get 90% of your initial investment back instead of 60% like the rest of America who invested in the S&P 500 in a normal index fund. Now on the upside, it's capped. We have that in this example, a 25% cap. So if the S&P 500 is up 20%, you would get, the 20% interest. So if you invested $10,000, you'd get $12,000 back. The S&P 500 is up 40% 2 years from now, you would only get $12,500 back, your initial $10,000 investment plus 25% because the cap is 25. So again, not for everyone, definitely more complicated, but it's kind of a way to protect your investment from the downside risk that the stock market offers while still participating somewhat in the upside of it. So for some people, again, they maybe don't want to dive headfirst into investing their money, but they like the idea of they got more cash than they need. They like the idea of getting some potential for upside, but as long as they get their principal back, they're content. You're not losing money. That for some of you, for a portion of your cash, that could be attractive, or maybe a portion of your invested assets too, in your IRA or brokerage account or whatever. So does that make sense, Rachelle?
Yeah, so I think it all makes sense. It's just one of those things where if it's something you're interested in, you really just have to go out and find more information about what this looks like, where you can get it, like all of that kind of stuff, and try to choose a product that's right for you. And it really just depends on what your goals are, what your risk tolerance is, all of that kind of stuff. I think the bottom line with all of this is just if you have extra money sitting around and you don't need it anytime soon, ideally we can put it towards some sort of long-term investing, retirement savings, things like that. And that just means, well diversified investments. But if you have extra money that you need just for short term, or if you have extra money that's set aside for emergencies, let's try to get it into something that's going to give you some sort of yield. And the product that you choose may depend a little bit, again, on your risk tolerance. If it is emergency reserves, probably just put it in one of those high interest savings accounts because it's liquid. And in that case, the liquidity is really important, just being able to get to it when you need it. But then there's all these other tools. If you have a year or more where you're not going to need that money, there's lots of options out there. So I know I have quite a few clients I think that are holding on to cash specifically because they want to buy a home and they just feel like it's not the right time because prices haven't come back a lot. They've come back a little bit and mortgage payments are a lot higher because interest rates are a lot higher. And they just don't want to commit at this point to that, or they're just not financially ready to do that. So they're saving money and some of them are saving quite a bit of money. So I think this is definitely something worth exploring for folks like that who are just sitting on a good chunk of money.
Yep, good problems to have when you have extra money lying around and trying to figure out what to do with it.
I guess that's what it comes down to, really. It's like this is not intended to be like a stress inducing episode like, oh no, I need to figure out what to do with my money. It's just, hey, here's a way where you can have your existing money earn you a little bit more on the side, and just make it a little more efficient for you.
There we go. Well, thanks for listening, and we'll see you next time.